Decoding the Fidelity Bitcoin ETF, Insights, Strategies, and Future Prospects. Welcome to our YouTube video where we delve into the intriguing world of digital asset investing and explore the factors behind the launch of the Fidelity Bitcoin ETF. In this video, we'll uncover the unique features of the Fidelity Bitcoin ETF, its underlying methodology, advantages for institutional investors, and its potential future developments. Join us as we navigate the complexities of Bitcoin ETFs and shed light on how the Fidelity Bitcoin ETF stands out in the competitive landscape of digital asset investments. Question 1. What specific factors led to the decision to launch a Fidelity Bitcoin ETF at this particular time? In the dynamic landscape of financial markets, the emergence of cryptocurrency as a viable asset class has sparked considerable interest among institutional investors. Fidelity Investments, a prominent player in the investment management industry, has recently announced its foray into the cryptocurrency space with the launch of a Bitcoin exchange-traded fund, ETF. This move begs the question: what specific factors prompted Fidelity to enter the market with a Bitcoin ETF at this particular juncture? 1. Understanding Fidelity's strategic vision. To comprehend the rationale behind Fidelity's decision, it's crucial to delve into the company's overarching strategic vision. Fidelity has long been recognized for its commitment to innovation and staying ahead of market trends. With an eye toward future growth opportunities, the company has continually sought to expand its product offerings and cater to evolving investor preferences. 2. Recognizing the maturation of the cryptocurrency market. One of the key drivers behind Fidelity's Bitcoin ETF launch is the maturation of the cryptocurrency market itself. Over the past decade, Bitcoin has transitioned from a fringe asset to a mainstream investment option, garnering increasing acceptance from institutional investors and regulators alike. As regulatory clarity improves and investor confidence grows, the timing becomes ripe for established financial institutions like Fidelity to introduce cryptocurrency investment products. 3. Meeting investor demand for exposure to Bitcoin. Another factor driving Fidelity's decision is the burgeoning demand among investors for exposure to Bitcoin. As interest in digital assets continues to soar, traditional asset managers face mounting pressure to provide clients with access to this burgeoning asset class. By launching a Bitcoin ETF, Fidelity seeks to meet this demand head-on, offering investors a convenient and regulated vehicle for gaining exposure to Bitcoin's potential upside while mitigating some of the associated risks. 4. Capitalizing on ETFs as an investment vehicle. ETFs have emerged as one of the most popular investment vehicles among both retail and institutional investors due to their low costs, liquidity, and tax efficiency. By introducing a Bitcoin ETF, Fidelity aims to leverage the inherent advantages of ETFs to make Bitcoin more accessible and appealing to a broader swath of investors. Additionally, the ETF structure allows for greater flexibility in trading and portfolio management, which can be particularly advantageous in the fast-paced world of cryptocurrency markets. 5. Differentiating Fidelity's offering in the market. In a crowded field of cryptocurrency investment products, differentiation is key to success. Fidelity's Bitcoin ETF is poised to stand out by virtue of the company's sterling reputation, extensive resources, and commitment to regulatory compliance. Moreover, Fidelity's ETF may offer unique features or investment strategies designed to appeal to a specific segment of the market, further enhancing its competitive edge. The decision to launch a Bitcoin ETF represents a strategic milestone for Fidelity Investments, signaling the company's embrace of cryptocurrency as a legitimate asset class. By entering the market with a regulated and transparent investment vehicle, Fidelity aims to capitalize on the growing interest in Bitcoin while providing investors with a trusted and convenient means of gaining exposure to this dynamic asset. As the cryptocurrency landscape continues to evolve, Fidelity's foray into the Bitcoin ETF space underscores the company's commitment to innovation and its readiness to adapt to the changing needs of investors. Question 2. How does the Fidelity Bitcoin ETF differentiate itself from existing Bitcoin investment options like Grayscale Bitcoin Trust, GBTC? In the rapidly evolving landscape of cryptocurrency investments, investors are presented with an array of options to gain exposure to Bitcoin. Among these options, two prominent vehicles stand out: the Fidelity Bitcoin ETF and the Grayscale Bitcoin Trust, GBTC. While both offer exposure to Bitcoin, they do so through different structures and mechanisms. This article seeks to dissect and compare the key differentiating factors between these two investment options, shedding light on their respective strengths and weaknesses. 1. Structure and regulatory framework. The most fundamental difference between the Fidelity Bitcoin ETF and GBTC lies in their underlying structures and regulatory frameworks. The Fidelity Bitcoin ETF operates as an exchange-traded fund, subject to the regulatory oversight of the Securities and Exchange Commission, SEC. In contrast, GBTC functions as a trust, offering shares that represent ownership of Bitcoin held by the trust. While GBTC provides exposure to Bitcoin, it does so without direct regulatory oversight as a traditional ETF would, which may entail different risks and considerations for investors. 2. Transparency and reporting standards. Transparency is a critical consideration for investors seeking exposure to Bitcoin. In this regard, the Fidelity Bitcoin ETF holds a distinct advantage over GBTC. As an ETF, Fidelity's offering is required to adhere to stringent reporting standards set forth by regulatory authorities. This means investors can access real-time pricing information, portfolio holdings, and other relevant data, providing greater transparency and visibility into the underlying assets. On the other hand, GBTC's reporting practices may not be as robust or timely, potentially leaving investors in the dark regarding the trust's operations and holdings. 3. Cost structure and fees. Cost is a crucial factor for investors when evaluating investment options. In terms of fees, the Fidelity Bitcoin ETF may offer a more cost-effective solution compared to GBTC. ETFs typically have lower expense ratios and management fees, making them a more cost-efficient way to gain exposure to Bitcoin over the long term. Conversely, GBTC charges a premium over the net asset value, NAV, of its underlying Bitcoin holdings, which can result in higher costs for investors over time. Additionally, GBTC may impose other fees and expenses associated with trust management, further eroding potential returns for investors. 4. Liquidity and trading dynamics. Liquidity and trading dynamics play a significant role in determining the ease and efficiency of buying and selling investment products. In this regard, the Fidelity Bitcoin ETF may enjoy an advantage over GBTC. As an ETF, Fidelity's offering is traded on major stock exchanges, providing investors with access to deep and liquid markets. This means investors can buy and sell shares of the ETF throughout the trading day at prevailing market prices, with the ability to execute trades quickly and efficiently. On the other hand, GBTC trades over the counter, OTC, which may result in less liquidity and wider bid-ask spreads, potentially impacting the cost of trading for investors. 5. Custody and security measures. Custody and security are paramount considerations when investing in Bitcoin, given the digital asset's susceptibility to theft and hacking. In this regard, both the Fidelity Bitcoin ETF and GBTC employ robust custody and security measures to safeguard investors' assets. Fidelity, as a trusted financial institution, may offer investors greater peace of mind with its proven track record in custody services and adherence to best practices in security protocols. Similarly, GBTC utilizes industry-leading custody solutions to protect its Bitcoin holdings, although the specifics of its custody arrangements may differ from those of traditional ETFs. 6. Tax implications and regulatory considerations. Taxation and regulatory considerations are important factors that investors must take into account when investing in Bitcoin. While both the Fidelity Bitcoin ETF and GBTC provide exposure to Bitcoin, they may differ in their tax treatment and regulatory implications. As an ETF, Fidelity's offering may be subject to specific tax rules governing ETFs, such as capital gains taxation upon sale of shares. In contrast, GBTC's tax treatment may resemble that of owning physical Bitcoin, potentially resulting in different tax consequences for investors. Additionally, regulatory developments and changes in the regulatory landscape may impact the operation and viability of both investment options, highlighting the importance of staying abreast of regulatory developments. The Fidelity Bitcoin ETF and Grayscale Bitcoin Trust, GBTC, represent two distinct avenues for investors to gain exposure to Bitcoin. While both offer access to the digital asset, they do so through different structures and mechanisms, each with its own set of advantages and considerations. The Fidelity Bitcoin ETF stands out for its adherence to regulatory standards, transparency, and cost-effectiveness, making it an attractive option for investors seeking a regulated and efficient way to invest in Bitcoin. On the other hand, GBTC provides investors with a convenient and accessible means of gaining exposure to Bitcoin, albeit with potentially higher costs and less transparency. Question 3. What is the insights into the underlying methodology for selecting and weighting assets within the Fidelity Bitcoin ETF? As the cryptocurrency market continues to mature, investors are increasingly seeking regulated and transparent vehicles to gain exposure to digital assets such as Bitcoin. The Fidelity Bitcoin ETF has emerged as one such option, offering investors a convenient and regulated means of accessing the potential upside of Bitcoin while mitigating some of the associated risks. Central to the success of any ETF is its underlying methodology for selecting and weighting assets. The following will delve deep into the methodology behind the Fidelity Bitcoin ETF, shedding light on how assets are chosen and allocated within the fund. 1. Defining the investment universe. The first step in constructing the Fidelity Bitcoin ETF's portfolio is defining the investment universe. Given that the ETF focuses exclusively on Bitcoin, the investment universe is relatively straightforward compared to broader-based ETFs. The ETF's methodology likely specifies that only Bitcoin, the pioneering cryptocurrency, is eligible for inclusion in the portfolio, excluding other digital assets such as Ethereum, Litecoin, or Ripple. This narrow focus allows the ETF to offer investors pure exposure to Bitcoin without diluting its investment thesis with other cryptocurrencies. 2. Quantitative analysis and research. Once the investment universe is established, the next step involves quantitative analysis and research to identify suitable assets for inclusion in the ETF's portfolio. Fidelity's team of analysts and researchers likely employs a variety of quantitative models and methodologies to assess the investment merits of different Bitcoin holdings. This analysis may encompass factors such as historical performance, volatility, liquidity, correlation with other assets, and fundamental metrics derived from on-chain data or market indicators. 3. Fundamental factors and qualitative considerations. In addition to quantitative analysis, qualitative considerations play a crucial role in asset selection within the Fidelity Bitcoin ETF. Factors such as the technological innovation behind Bitcoin, its adoption rate, regulatory environment, and macroeconomic trends may influence the ETF's investment decisions. Fidelity's team of experts may conduct in-depth due diligence on each potential holding, assessing factors beyond pure financial metrics to gauge its long-term viability and suitability for inclusion in the portfolio. 4. Risk management and portfolio construction. Risk management is paramount in constructing any investment portfolio, and the Fidelity Bitcoin ETF is no exception. The ETF's methodology likely incorporates rigorous risk management techniques to mitigate potential downside risks associated with Bitcoin investments. This may involve diversification across different Bitcoin holdings to reduce concentration risk, setting maximum exposure limits to individual assets, and implementing dynamic rebalancing mechanisms to maintain desired portfolio characteristics over time. 5. Weighting methodology and portfolio optimization. Once suitable assets are identified, the next step is determining their weightings within the Fidelity Bitcoin ETF's portfolio. The ETF's methodology may employ various weighting schemes, ranging from traditional market cap weighting to more sophisticated methodologies such as equal weighting, factor-based weighting, or risk parity strategies. The choice of weighting methodology will depend on factors such as the ETF's investment objectives, risk tolerance, and views on market efficiency. 6. Transparency and disclosure. Transparency is a hallmark of the ETF industry, and the Fidelity Bitcoin ETF is no exception. The ETF's methodology likely outlines clear guidelines for asset selection, weighting, and portfolio construction, which are disclosed to investors in the fund's prospectus and other regulatory filings. Additionally, the ETF issuer may provide regular updates and disclosures regarding changes to the portfolio composition, allowing investors to stay informed about the fund's investment strategy and decision-making process. The methodology behind the Fidelity Bitcoin ETF plays a crucial role in shaping the fund's investment strategy and portfolio composition. By employing a rigorous and systematic approach to asset selection and weighting, the ETF aims to provide investors with exposure to Bitcoin's potential upside while managing associated risks. Transparency, research-driven analysis, and risk management are key pillars of the ETF's methodology, underscoring Fidelity's commitment to delivering a regulated and transparent investment vehicle for accessing the digital asset market. As the cryptocurrency landscape continues to evolve, the Fidelity Bitcoin ETF's methodology will likely adapt to changing market dynamics, ensuring that the fund remains well-positioned to capture opportunities and navigate challenges in the dynamic world of Bitcoin investments. Question 4. What are the key advantages and disadvantages for institutional investors choosing the Fidelity Bitcoin ETF over other options? The emergence of the Fidelity Bitcoin ETF has sparked significant interest among institutional investors seeking regulated and transparent vehicles to gain exposure to the digital asset market. As institutions navigate the complex landscape of cryptocurrency investments, it becomes imperative to assess the advantages and disadvantages of the Fidelity Bitcoin ETF relative to other available options. The following will delve into the key factors that institutional investors should consider when evaluating the Fidelity Bitcoin ETF as a potential investment vehicle. Advantages of the Fidelity Bitcoin ETF for institutional investors. 1. Regulatory oversight and compliance. One of the primary advantages of the Fidelity Bitcoin ETF is its regulatory oversight and compliance framework. As an exchange-traded fund (ETF), the Fidelity Bitcoin ETF is subject to stringent regulatory standards set forth by authorities such as the Securities and Exchange Commission (SEC). This regulatory oversight provides institutional investors with a level of confidence and assurance regarding the ETF's operations, custodianship of assets, and adherence to best practices in governance and transparency. 2. Transparency and reporting standards. Transparency is critical for institutional investors when evaluating investment options. The Fidelity Bitcoin ETF offers a high degree of transparency, with real-time pricing information, portfolio holdings, and other relevant data readily available to investors. This transparency enables institutions to conduct thorough due diligence, monitor the fund's performance, and make informed investment decisions. Additionally, the ETF's adherence to stringent reporting standards enhances visibility into its operations, fostering trust and accountability among institutional investors. 3. Liquidity and trading dynamics. Liquidity and trading dynamics are essential considerations for institutional investors, particularly those managing large portfolios. The Fidelity Bitcoin ETF benefits from its listing on major stock exchanges, providing investors with access to deep and liquid markets. This liquidity allows institutional investors to execute trades quickly and efficiently, without incurring significant market impact costs. Furthermore, the ETF's tradability throughout the trading day enhances flexibility in portfolio management and risk mitigation strategies. 4. Cost efficiency. Cost efficiency is a key determinant of investment returns for institutional investors. The Fidelity Bitcoin ETF may offer a more cost-effective solution compared to other investment options such as actively managed funds or private investment vehicles. ETFs typically have lower expense ratios and management fees, resulting in lower overall costs for investors. This cost efficiency is particularly advantageous for institutional investors managing large portfolios, as it helps enhance net returns and mitigate the drag on performance caused by high fees. 5. Accessibility and convenience. The Fidelity Bitcoin ETF provides institutional investors with convenient access to the digital asset market. Unlike direct investments in Bitcoin or other cryptocurrency products, which may involve complex custodial arrangements and operational challenges, the ETF offers a simple and straightforward way to gain exposure to Bitcoin. Additionally, the ETF structure allows for easy integration into existing investment portfolios, providing institutions with a seamless and efficient means of diversifying their holdings and managing risk. Disadvantages of the Fidelity Bitcoin ETF for institutional investors. 1. Limited investment universe. One potential disadvantage of the Fidelity Bitcoin ETF is its limited investment universe. As an ETF focused exclusively on Bitcoin, the fund may lack diversification compared to other investment options that offer exposure to a broader range of assets. This concentration risk could expose institutional investors to heightened volatility and downside risk, particularly in periods of market turbulence or regulatory uncertainty specific to Bitcoin. 2. Market volatility and risk. Bitcoin is known for its inherent volatility and price fluctuations, which can pose challenges for institutional investors seeking stable returns and capital preservation. While the Fidelity Bitcoin ETF may offer exposure to Bitcoin's potential upside, it also entails exposure to the associated risks and uncertainties inherent in the cryptocurrency market. Institutional investors must carefully assess their risk tolerance and investment objectives before allocating capital to the ETF, taking into account the potential impact of market volatility on portfolio performance. 3. Regulatory and legal considerations. While regulatory oversight can provide institutional investors with confidence and assurance, it also introduces regulatory and legal considerations that may impact the operation and viability of the Fidelity Bitcoin ETF. Regulatory developments, changes in tax laws, or adverse regulatory rulings specific to Bitcoin or ETFs could have implications for the fund's operations and investor returns. Institutional investors must stay abreast of regulatory developments and assess the potential risks and implications for their investment portfolios. 4. Counterparty risk. Despite the Fidelity Bitcoin ETF's regulatory oversight and custodial arrangements, institutional investors are still exposed to counterparty risk associated with the ETF service providers, including the fund's custodian, administrator, and other counterparties. While Fidelity is a reputable financial institution with a proven track record in custody services, institutional investors must consider the potential impact of counterparty risk on their investment portfolios and implement appropriate risk management strategies to mitigate exposure. 5. Performance and tracking error. ETFs are designed to track the performance of their underlying benchmark or index as closely as possible. However, factors such as tracking error, management fees, and other costs can impact the ETF's performance relative to the underlying asset. Institutional investors should carefully evaluate the Fidelity Bitcoin ETF's historical performance, tracking efficiency, and total cost of ownership to assess its suitability as an investment option. Additionally, institutions may consider alternative investment vehicles or strategies to achieve their investment objectives, with lower tracking error and better risk-adjusted returns. The Fidelity Bitcoin ETF offers institutional investors a regulated and transparent vehicle to gain exposure to the digital asset market. With advantages such as regulatory oversight, transparency, liquidity, cost efficiency, and accessibility, the ETF presents compelling opportunities for institutions seeking to capitalize on the potential upside of Bitcoin while managing associated risks. However, institutional investors must also consider the limitations and challenges associated with the ETF, including concentration risk, market volatility, regulatory considerations, counterparty risk, and performance tracking. By conducting thorough due diligence and risk assessments, institutional investors can make informed decisions about incorporating the Fidelity Bitcoin ETF into their investment portfolios, balancing the potential benefits and drawbacks to achieve their investment objectives. Question 5. Does the issuer plan to offer an actively managed Fidelity Bitcoin ETF in the future, or will all Fidelity Bitcoin ETFs be passively managed? The launch of the Fidelity Bitcoin ETF has generated significant buzz within the investment community, providing investors with a regulated and transparent vehicle to gain exposure to the burgeoning cryptocurrency market. As institutional and retail investors alike flock to Bitcoin as a potential hedge against inflation and a store of value, questions arise about the future direction of Fidelity's Bitcoin ETF offerings. Specifically, investors are curious whether the issuer plans to introduce actively managed Fidelity Bitcoin ETFs in addition to the current passively managed option. We delve into this question, examining the potential benefits and challenges of both passive and active management strategies for Fidelity Bitcoin ETFs. 1. Passive management. The current landscape passive management, as exemplified by the current Fidelity Bitcoin ETF, involves tracking a specific benchmark or index to replicate the performance of the underlying asset or market segment. In the case of the Fidelity Bitcoin ETF, the fund aims to mirror the performance of Bitcoin by holding physical Bitcoin or Bitcoin futures contracts. Passive management offers several advantages, including low costs, transparency, and simplicity. By tracking the performance of Bitcoin, the ETF provides investors with exposure to the digital asset without the need for active investment decisions or market timing. 2. The case for active management. Potential benefits. While passive management has gained popularity in recent years, some investors advocate for the introduction of actively managed Fidelity Bitcoin ETFs. Active management involves employing a team of investment professionals to actively select and manage investments with the goal of outperforming the market or achieving specific investment objectives. In the context of Bitcoin, active management may offer several potential benefits, including a. Alpha generation. Active managers have the flexibility to deviate from the benchmark and capitalize on market inefficiencies or mispricings. In the dynamic and often volatile cryptocurrency market, active management may enable Fidelity Bitcoin ETFs to generate alpha by strategically allocating capital, timing trades, and exploiting short-term opportunities. B. Risk management. Active managers can actively manage risk by adjusting portfolio allocations, hedging positions, or implementing dynamic risk management strategies. In the context of Bitcoin, active management may allow Fidelity Bitcoin ETFs to navigate market volatility, mitigate downside risk, and capitalize on emerging trends or market developments. C. Innovation and differentiation. Actively managed Fidelity Bitcoin ETFs may differentiate themselves from passive offerings by offering unique investment strategies, thematic exposures, or active trading strategies. By leveraging Fidelity's expertise in research, technology, and investment management, actively managed ETFs may attract investors seeking alpha generation, innovation, and active portfolio management. Considerations and constraints. While active management offers potential benefits, it also entails certain challenges and considerations for Fidelity Bitcoin ETFs. These challenges include: A. Higher costs. Actively managed Fidelity Bitcoin ETFs typically incur higher costs compared to passive ETFs due to research, management fees, and trading expenses. Higher costs may erode potential returns and impact the ETF's competitiveness relative to passive alternatives, particularly in a price-sensitive market environment. B. Manager selection and performance. The success of actively managed Fidelity Bitcoin ETFs hinges on the skill and expertise of the portfolio manager or investment team. Selecting experienced and skilled managers capable of generating alpha in the cryptocurrency market is paramount but challenging. Additionally, the performance of actively managed ETFs may vary over time, subjecting investors to manager risk and performance uncertainty. C. Transparency and disclosure. Active management may introduce challenges related to transparency and disclosure, as managers may trade more frequently, hold proprietary investment strategies, or deviate from the benchmark. Transparency is a cornerstone of ETF investing, and actively managed Fidelity Bitcoin ETFs must balance the need for transparency with the desire to protect proprietary investment strategies and competitive advantages. Passive versus active management. As of now, Fidelity has not announced plans to offer actively managed Fidelity Bitcoin ETFs, and all existing Fidelity Bitcoin ETFs are passively managed. However, the issuer may explore the possibility of introducing actively managed ETFs in the future, contingent upon market demand, regulatory considerations, and the competitive landscape. Fidelity's decision to offer actively managed Fidelity Bitcoin ETFs would likely depend on various factors, including: A. Investor demand. Fidelity may gauge investor demand for actively managed Fidelity Bitcoin ETFs through market research, client feedback, and consultations with institutional and retail investors. If there is sufficient demand for active management and alpha generation in the cryptocurrency market, Fidelity may consider introducing actively managed ETFs to meet investor preferences and enhance its product lineup. B. Regulatory approval. The launch of actively managed Fidelity Bitcoin ETFs would require regulatory approval from authorities such as the Securities and Exchange Commission, SEC. Fidelity must demonstrate compliance with regulatory requirements, disclose relevant information to investors, and ensure adequate risk management and governance frameworks to obtain regulatory approval for actively managed ETFs. C. Competitive landscape. Fidelity operates in a competitive landscape with other ETF issuers offering both passive and actively managed Bitcoin ETFs. Fidelity must assess the competitive landscape, differentiate its offerings, and evaluate the potential benefits and drawbacks of active management relative to passive alternatives. By conducting a thorough analysis of market dynamics, competitor strategies, and investor preferences, Fidelity can make informed decisions about the future direction of its Bitcoin ETF offerings. The question of whether Fidelity plans to offer actively managed Fidelity Bitcoin ETFs remains open, with potential implications for institutional and retail investors alike. While passive management currently dominates the landscape, active management offers potential benefits such as alpha generation, risk management, and innovation. Fidelity must carefully weigh the benefits and challenges of active management, assess market demand, regulatory considerations, and competitive dynamics, and make strategic decisions about the future direction of its Bitcoin ETF offerings. As the cryptocurrency market continues to evolve, Fidelity's approach to passive versus active management will shape its role as a leading ETF issuer and provider of digital asset investment solutions. Question 6. Will the Fidelity Bitcoin ETF employ any hedging strategies to mitigate price volatility or exposure to other asset classes? Hedging strategies are risk management techniques designed to offset or mitigate the impact of adverse price movements in an asset or portfolio. In the context of the Fidelity Bitcoin ETF, hedging strategies may involve taking positions in other assets or derivatives to hedge against downside risk, volatility, or correlation with other asset classes. Hedging strategies aim to protect investors' capital, preserve portfolio value, and enhance risk-adjusted returns, particularly in volatile or uncertain market environments. Potential hedging strategies for the Fidelity Bitcoin ETF. A. Option strategies. Options are derivative contracts that give investors the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specified period. Option strategies, such as protective puts or collars, may be employed by the Fidelity Bitcoin ETF to hedge against downside risk or limit potential losses. Protective puts, for example, allow investors to purchase put options to protect against a decline in the price of Bitcoin, while collars involve combining long positions in Bitcoin with options to establish price boundaries within which the ETF's value can fluctuate. B. Futures contracts. Futures contracts are standardized agreements to buy or sell a specified asset at a predetermined price on a future date. The Fidelity Bitcoin ETF may utilize Bitcoin futures contracts to hedge against price volatility or manage exposure to Bitcoin. By taking short positions in Bitcoin futures contracts, the ETF can offset potential losses in its physical Bitcoin holdings if prices decline. Conversely, long positions in Bitcoin futures contracts may be used to hedge against the risk of adverse price movements in the ETF's portfolio. C. Currency hedging. Currency hedging involves mitigating the impact of fluctuations in exchange rates on portfolio returns. Given Bitcoin's status as a global digital currency, exposure to foreign exchange risk may impact the Fidelity Bitcoin ETF's performance. Currency hedging strategies, such as forward contracts or currency options, may be employed to hedge against currency risk and stabilize the ETF's returns, particularly for investors holding shares denominated in different currencies. D. Diversification. Diversification is a fundamental hedging strategy that involves spreading investments across different asset classes, sectors, or regions to reduce concentration risk and enhance portfolio resilience. While the Fidelity Bitcoin ETF focuses primarily on Bitcoin, the fund may incorporate other digital assets, cryptocurrencies, or traditional assets into its portfolio to achieve diversification benefits. By diversifying its holdings, the ETF can mitigate single-source risk and potentially improve risk-adjusted returns for investors. Considerations and implications of hedging strategies. While hedging strategies offer potential benefits for the Fidelity Bitcoin ETF, they also entail certain considerations and implications for investors. A. Costs. Hedging strategies may incur costs in the form of transaction fees, bid-ask spreads, and other expenses, which can impact the ETF's overall performance and cost-effectiveness. Investors should assess the costs associated with hedging strategies relative to the potential benefits and consider whether the expenses justify the risk mitigation provided. B. Effectiveness. The effectiveness of hedging strategies depends on various factors, including market conditions, liquidity, execution quality, and the correlation between hedging instruments and the underlying asset. Investors should evaluate the historical performance and track record of hedging strategies employed by the Fidelity Bitcoin ETF to gauge their effectiveness in mitigating downside risk and managing volatility. C. Regulatory considerations. Hedging strategies may be subject to regulatory oversight and compliance requirements, particularly in highly regulated markets such as the United States. The Fidelity Bitcoin ETF must adhere to regulatory guidelines, disclose relevant information to investors, and ensure compliance with applicable laws and regulations governing derivatives, options, futures, and other hedging instruments. D. Market impact. Hedging strategies may have an impact on market dynamics, liquidity, and price discovery in the Bitcoin market. Large-scale hedging activities by the Fidelity Bitcoin ETF or other market participants may influence Bitcoin prices, volatility, and trading volumes, potentially affecting the ETF's performance and investor returns. As of now, Fidelity has not disclosed specific details about the hedging strategies employed by the Fidelity Bitcoin ETF or any plans to implement hedging strategies in the future. However, given the inherent volatility and risk associated with Bitcoin investments, it is reasonable to assume that Fidelity may explore various hedging techniques to manage risk, protect investor capital, and enhance the ETF's risk-adjusted returns. The potential use of hedging strategies by the Fidelity Bitcoin ETF presents both opportunities and challenges for investors. While hedging strategies offer potential benefits in terms of risk management, volatility mitigation, and portfolio diversification, they also entail costs, regulatory considerations, and market implications. Investors should carefully evaluate the effectiveness, costs, and implications of hedging strategies employed by the Fidelity Bitcoin ETF, considering their investment objectives, risk tolerance, and market outlook. As the cryptocurrency market continues to evolve, Fidelity's approach to hedging will play a crucial role in shaping the risk profile and performance of the Fidelity Bitcoin ETF, providing investors with a regulated and transparent vehicle to gain exposure to Bitcoin while managing associated risks. Question 7. How will the performance of the Fidelity Bitcoin ETF be measured and benchmarked against traditional and alternative assets? As the cryptocurrency market continues to mature, investors are increasingly turning to vehicles like the Fidelity Bitcoin ETF to gain exposure to digital assets like Bitcoin. However, assessing the performance of the Fidelity Bitcoin ETF requires a nuanced understanding of how it compares to traditional and alternative assets. The following will explore how the performance of the Fidelity Bitcoin ETF will be measured and benchmarked against traditional and alternative assets, shedding light on the methodologies, implications, and considerations for investors. Defining performance metrics. Before delving into benchmarking, it's essential to define the performance metrics used to evaluate the Fidelity Bitcoin ETF. Common performance metrics include: A. Total return. Total return measures the change in the ETF's value over a specific period, including both price appreciation and dividends or distributions reinvested. Total return provides a comprehensive view of the ETF's performance, accounting for both capital gains and income generated by the underlying assets. B. Price return. Price return measures the change in the ETF's price over a specific period, excluding dividends or distributions. Price return reflects changes in the ETF's market value and is commonly used to assess capital appreciation or depreciation. C. Risk-adjusted return. Risk-adjusted return measures the ETF's performance relative to its level of risk, taking into account metrics such as volatility, beta, or Sharpe ratio. Risk-adjusted return provides insight into how effectively the ETF generates returns relative to the level of risk assumed, allowing investors to compare performance across different assets on a risk-adjusted basis. D. Tracking error. Tracking error measures the deviation between the ETF's performance and its benchmark or index. A lower tracking error indicates that the ETF closely tracks its benchmark, while a higher tracking error suggests potential deviations from the benchmark due to factors such as portfolio composition, trading costs, or management style. Traditionally, investors benchmark the performance of ETFs against traditional asset classes such as stocks, bonds, and commodities. The Fidelity Bitcoin ETF may be benchmarked against broad-based equity indices like the S&P 500 or global equity indices like the MSCI World Index to assess its performance relative to traditional equity investments. Additionally, fixed-income benchmarks such as the Bloomberg Barclays U.S. Aggregate Bond Index or the FTSE TMX Canada Universe Bond Index may serve as benchmarks for assessing the ETF's performance relative to traditional fixed-income investments. In addition to traditional assets, investors may benchmark the performance of the Fidelity Bitcoin ETF against alternative assets such as gold, real estate, or other cryptocurrencies. Gold, often considered a hedge against inflation and currency debasement, serves as a common benchmark for assessing the performance of Bitcoin and other digital assets. Real estate indices, such as the FTSE Nareit Equity REITs Index or the S&P CoreLogic Case-Shiller Home Price Index, may provide benchmarks for evaluating the ETF's performance relative to real estate investments. Furthermore, cryptocurrency indices like the Bloomberg Galaxy Crypto Index or the CoinDesk Bitcoin Price Index may serve as benchmarks for comparing the ETF's performance to other cryptocurrencies or digital asset portfolios. Benchmarking the performance of the Fidelity Bitcoin ETF against traditional and alternative assets involves several methodologies. A. Relative performance analysis. Relative performance analysis compares the ETF's returns to those of its benchmark or index over a specific period, measuring the ETF's outperformance or underperformance relative to the benchmark. Relative performance analysis allows investors to assess how effectively the ETF generates returns compared to its benchmark and identify potential sources of alpha or excess returns. B. Attribution analysis. Attribution analysis breaks down the ETF's performance into various factors, such as asset allocation, security selection, and market timing. By analyzing the sources of the ETF's performance relative to its benchmark, attribution analysis helps investors understand the drivers of returns and assess the effectiveness of the ETF's investment strategy and management decisions. C. Peer group comparison. Peer group comparison involves comparing the performance of the Fidelity Bitcoin ETF to that of similar ETFs or investment products within the same asset class or category. By benchmarking against peer group indices or benchmarks, investors can assess how the ETF stacks up against its competitors and identify relative strengths or weaknesses. D. Risk-adjusted performance metrics. Risk-adjusted performance metrics such as the Sharpe ratio, Trainer ratio, or information ratio provide insight into how effectively the ETF generates returns relative to its level of risk. By comparing risk-adjusted performance metrics to those of its benchmark or peer group, investors can evaluate the ETF's risk-adjusted returns and assess its efficiency in generating returns relative to the risk assumed. When benchmarking the performance of the Fidelity Bitcoin ETF against traditional and alternative assets, investors should consider several factors. A. Market dynamics. The performance of the Fidelity Bitcoin ETF may be influenced by various market dynamics, including macroeconomic factors, regulatory developments, technological advancements, and investor sentiment. Investors should assess how these factors impact the ETF's performance relative to its benchmarks and peer group. B. Volatility and risk. Bitcoin and other digital assets are known for their volatility and risk, which can impact the performance of the Fidelity Bitcoin ETF. Investors should consider the ETF's risk profile, volatility, and correlation with other asset classes when benchmarking its performance and evaluating its suitability for their investment portfolios. C. Diversification benefits. The Fidelity Bitcoin ETF may offer diversification benefits by providing exposure to an asset class with low correlation to traditional assets like stocks and bonds. Investors should assess the ETF's diversification potential and its impact on portfolio risk and returns when benchmarking its performance against traditional and alternative assets. D. Long-term investment objectives. Investors should align the benchmarking of the Fidelity Bitcoin ETF with their long-term investment objectives, risk tolerance, and investment horizon. While short-term performance comparisons provide insights into the ETF's relative performance, long-term performance analysis is crucial for evaluating its ability to meet investors' long-term investment goals and objectives. Benchmarking the performance of the Fidelity Bitcoin ETF against traditional and alternative assets involves assessing its returns, risk-adjusted performance, tracking error, and other metrics relative to relevant benchmarks and peer groups. By employing various methodologies for benchmarking performance, investors can gain insights into how effectively the ETF generates returns, manages risk, and contributes to portfolio diversification. As the cryptocurrency market continues to evolve, benchmarking the performance of the Fidelity Bitcoin ETF will remain a critical tool for investors to evaluate its performance, monitor its competitiveness, and make informed investment decisions aligned with their investment objectives and risk preferences. Question 8. How will the Fidelity Bitcoin ETF address the contango or backwardation in the Bitcoin futures market, and how might it impact the Fidelity Bitcoin ETF's performance compared to the spot Bitcoin price? The launch of the Fidelity Bitcoin ETF has provided investors with a regulated and transparent vehicle to gain exposure to the digital asset market. However, as the ETF incorporates Bitcoin futures contracts into its portfolio, investors are curious about how it will address dynamics such as contango or backwardation in the Bitcoin futures market and how these factors might impact the ETF's performance relative to the spot Bitcoin price. The following will delve into the intricacies of contango, backwardation, and their implications for the Fidelity Bitcoin ETF, exploring strategies for managing futures dynamics and mitigating their impact on performance. Contango and backwardation are terms used to describe the relationship between futures prices and spot prices in commodity markets, including the Bitcoin futures market. A. Contango. Contango occurs when futures prices are higher than the spot price of the underlying asset. In a contango market, investors are willing to pay a premium for the convenience of owning the asset in the future, reflecting factors such as storage costs, financing costs, and market expectations of future supply and demand dynamics. Contango is common in commodity markets with carrying costs and tends to be the typical state of the futures curve in the Bitcoin market. B. Backwardation. Backwardation occurs when futures prices are lower than the spot price of the underlying asset. In a backwardation market, investors are willing to accept a discount for the inconvenience of deferring ownership of the asset to the future, indicating factors such as immediate demand, scarcity, or supply disruptions. Backwardation is less common but can occur in commodity markets during periods of supply shortages, geopolitical tensions, or market disruptions. Contango and backwardation can have significant implications for ETFs that hold futures contracts as part of their investment strategy, including the Fidelity Bitcoin ETF. A. Roll yield. Roll yield refers to the difference between the returns generated from rolling futures contracts forward and the spot price of the underlying asset. In a contango market, roll yield tends to be negative, as the ETF sells expiring futures contracts at lower prices and buys new contracts at higher prices. Conversely, in a backwardation market, roll yield tends to be positive, as the ETF sells expiring contracts at higher prices and buys new contracts at lower prices. B. Tracking error. Contango and backwardation can lead to tracking error, which measures the deviation between the ETF's performance and the spot price of the underlying asset. In a contango market, tracking error may be exacerbated by negative roll yield, causing the ETF's performance to lag behind the spot Bitcoin price. Conversely, in a backwardation market, tracking error may be reduced or even reversed, as positive roll yield helps the ETF outperform the spot price. C. Cost of carry. Contango and backwardation impact the cost of carry, which refers to the costs associated with holding futures contracts, including financing costs, storage costs, and opportunity costs. In a contango market, the cost of carry is positive, reflecting the premium investors pay for holding futures contracts. In a backwardation market, the cost of carry is negative, indicating a discount for holding futures contracts. Managing contango and backwardation in the Fidelity Bitcoin ETF. Given the potential impact of contango and backwardation on the performance of the Fidelity Bitcoin ETF, the issuer may employ various strategies to manage futures dynamics and mitigate their impact. A. Active roll strategy. The Fidelity Bitcoin ETF may adopt an active roll strategy to optimize the timing and execution of futures contract rollovers. By monitoring market conditions, liquidity, and roll yield, the ETF's management team can strategically roll futures contracts to minimize the impact of contango or maximize the benefits of backwardation. Active roll strategies involve assessing factors such as cost of carry, term structure, and market sentiment to determine the optimal timing for rolling contracts. B. Utilization of different futures expirations. The Fidelity Bitcoin ETF may utilize futures contracts with different expiration dates to manage contango and backwardation. By diversifying across multiple futures expirations, the ETF can spread the impact of roll yield over time and reduce the concentration of rollover risk in any single contract. Utilizing futures contracts with longer or shorter maturities may also provide opportunities to capture different points along the futures curve and optimize the ETF's exposure to futures dynamics. C. Hedging strategies. The Fidelity Bitcoin ETF may employ hedging strategies to mitigate the impact of contango or backwardation on performance. Hedging strategies, such as options overlays or dynamic hedging techniques, may be used to offset potential losses from negative roll yield in a contango market or enhance returns from positive roll yield in a backwardation market. Hedging strategies involve balancing the trade-offs between risk reduction, cost, and complexity, and may be tailored to the ETF's specific objectives and risk tolerance. D. Transparency and disclosure. Transparency is essential for investors to understand how the Fidelity Bitcoin ETF manages contango and backwardation and their impact on performance. The ETF issuer should provide clear disclosures and explanations of its roll strategy, utilization of futures contracts, and risk management practices related to futures dynamics. Transparency fosters investor confidence, enhances market integrity, and enables informed decision-making regarding the ETF's suitability for investment portfolios. The impact of contango and backwardation on the Fidelity Bitcoin ETF's performance relative to the spot Bitcoin price will depend on various factors, including market conditions, futures market dynamics, and the effectiveness of the ETF's management strategies. In a contango market, the ETF may experience negative roll yield, leading to tracking error and underperformance relative to the spot price. Conversely, in a backwardation market, the ETF may benefit from positive roll yield, potentially outperforming the spot price. Investors should closely monitor futures dynamics and consider the implications for the ETF's performance when evaluating its suitability for their investment portfolios. Contango and backwardation in the Bitcoin futures market pose challenges and opportunities for ETFs, like the Fidelity Bitcoin ETF. By understanding the dynamics of contango and backwardation, implementing effective management strategies, and maintaining transparency and disclosure, the ETF can navigate futures dynamics and mitigate their impact on performance. Investors should carefully assess the implications of contango and backwardation on the Fidelity Bitcoin ETF's performance relative to the spot Bitcoin price, and consider how these factors align with their investment objectives, risk tolerance, and market outlook. As the cryptocurrency market continues to evolve, managing futures dynamics will remain a critical consideration for ETF issuers and investors seeking exposure to digital assets like Bitcoin. Question 9. How does the issuer view the competitive landscape for Bitcoin ETFs, and what are the key differentiators that will position the Fidelity Bitcoin ETF for success? The emergence of Bitcoin exchange-traded funds (ETFs) has reshaped the landscape of digital asset investing, offering investors regulated and transparent access to the cryptocurrency market. Amidst growing interest from institutional and retail investors, ETF issuers must navigate a competitive landscape characterized by innovation, regulatory scrutiny, and evolving investor preferences. The following will explore how the issuer views the competitive landscape for Bitcoin ETFs and examine the key differentiators that will position the Fidelity Bitcoin ETF for success. Before delving into the specific differentiators of the Fidelity Bitcoin ETF, it's essential to understand the broader competitive landscape for Bitcoin ETFs. A. Market participants. The market for Bitcoin ETFs is populated by various issuers, including established financial institutions, asset managers, and cryptocurrency-focused firms. Each issuer brings unique strengths, capabilities, and brand recognition to the table, shaping the competitive dynamics of the market. B. Product offerings. Bitcoin ETFs come in different shapes and sizes, ranging from physically backed ETFs to futures-based ETFs and thematic ETFs. Issuers may differentiate their offerings based on factors such as custody solutions, investment strategies, expense ratios, and regulatory approvals, catering to diverse investor preferences and risk profiles. C. Regulatory environment. The regulatory landscape for Bitcoin ETFs varies across jurisdictions, with regulators imposing stringent requirements on ETF issuers to ensure investor protection, market integrity, and compliance with anti-money laundering (AML) and Know Your Customer (KYC) regulations. Regulatory approvals and compliance with regulatory standards are crucial factors influencing the competitiveness and viability of Bitcoin ETFs in the market. D. Investor demand. Investor demand for Bitcoin ETFs is driven by factors such as macroeconomic trends, market sentiment, institutional adoption, and retail investor interest. ETF issuers must gauge investor demand, anticipate market trends, and tailor their offerings to meet the evolving needs and preferences of institutional and retail investors. Against this backdrop, the issuer of the Fidelity Bitcoin ETF views several key differentiators that will position the ETF for success. A. Reputation and trust. Fidelity Investments, the issuer of the Fidelity Bitcoin ETF, is a globally recognized financial services firm with a strong reputation for trust, reliability, and innovation. With decades of experience in asset management, custody services, and financial technology, Fidelity brings credibility and institutional trust to its Bitcoin ETF offering, appealing to institutional investors seeking regulated and reputable investment vehicles. B. Regulatory compliance. The Fidelity Bitcoin ETF is designed to comply with regulatory requirements and industry best practices, providing investors with confidence and assurance regarding the ETF's operations, governance, and compliance standards. Fidelity's commitment to regulatory compliance, transparency, and investor protection distinguishes the ETF in the competitive landscape, mitigating regulatory risks and enhancing investor trust and confidence. C. Custody solutions. Custody solutions play a critical role in the security and integrity of Bitcoin ETFs, as they are responsible for safeguarding investors' assets against theft, fraud, and operational risks. Fidelity offers institutional-grade custody solutions through its subsidiary, Fidelity Digital Assets, leveraging best-in-class security protocols, cold storage infrastructure, and insurance coverage to protect investors' Bitcoin holdings. Fidelity's custody expertise and robust security measures differentiate the Fidelity Bitcoin ETF in the market, providing investors with peace of mind and confidence in the safety of their assets. D. Investment strategy. The Fidelity Bitcoin ETF may differentiate itself through its investment strategy, which may include a combination of physical Bitcoin holdings, Bitcoin futures contracts, and other derivative instruments. Fidelity's investment approach may focus on optimizing risk-adjusted returns, managing volatility, and capturing long-term appreciation potential in the Bitcoin market. By leveraging Fidelity's research capabilities, quantitative modeling, and risk management expertise, the ETF aims to deliver competitive performance relative to other Bitcoin ETFs in the market. E. Investor education and support. Fidelity is committed to investor education and support, providing resources, tools, and guidance to help investors navigate the complexities of the cryptocurrency market and make informed investment decisions. Through educational content, webinars, seminars, and personalized advisory services, Fidelity empowers investors to understand the risks and opportunities associated with Bitcoin investing and develop tailored investment strategies aligned with their financial goals and risk tolerance. Investor education and support initiatives differentiate the Fidelity Bitcoin ETF by fostering investor confidence, knowledge, and engagement. As the issuer of the Fidelity Bitcoin ETF, Fidelity Investments is well-positioned to capitalize on the growing demand for regulated and transparent access to Bitcoin. By leveraging its reputation, regulatory compliance, custody solutions, investment strategy, and investor support capabilities, Fidelity aims to differentiate the Fidelity Bitcoin ETF in the competitive landscape and position it for success. As the cryptocurrency market continues to evolve and mature, Fidelity's commitment to innovation, integrity, and investor-centric solutions will be crucial in capturing market share, attracting institutional and retail investors, and delivering long-term value to stakeholders. The competitive landscape for Bitcoin ETFs is characterized by diverse market participants, product offerings, regulatory requirements, and investor preferences. Against this backdrop, the Fidelity Bitcoin ETF distinguishes itself through its reputation, regulatory compliance, custody solutions, investment strategy, and investor support initiatives. By focusing on key differentiators and positioning itself as a trusted and innovative provider of Bitcoin ETFs, Fidelity aims to capture market share, enhance investor confidence, and drive long-term success in the dynamic and rapidly evolving cryptocurrency market. As we conclude our exploration of the Fidelity Bitcoin ETF, it's evident that this innovative investment vehicle holds significant promise for both institutional and retail investors seeking exposure to the dynamic world of cryptocurrencies. With its robust methodology, differentiated features, and potential for future developments, the Fidelity Bitcoin ETF is poised to make a meaningful impact in the digital asset space. Thank you for watching, and we hope you gained valuable insights into the exciting opportunities offered by the Fidelity Bitcoin ETF. Don't forget to like, share, and subscribe for more informative content on cryptocurrency investing. Until next time, happy investing!